When you think about the economic crisis in the United States, the mind skips to one preliminary topic, the Great Depression. For a country as strict and as powerful as ours, it would be thought that we would not be foolish enough to make the same mistake twice.
There's an old saying in Tennessee, I know it's in Texas, probably in Tennessee, that says, "Fool me once, shame on you." If fool me, we can't get fooled again.
But then 2008 came. In this video, you will learn the differences and similarities between the Great Depression and the Great Recession, as well as the reoccurring economic downfall. The precursor to the Great Depression and Great Recession seem far too similar, both with booming economies. As with any recession, the cliff must be high enough to jump from. The first thing to jump out at you while you're thinking about the Great Recession of 2008 is the mortgage crisis. This crisis can be traced specifically to the loans given out by small banks with small down payments and high payment loans. This is traced on the Federal Reserve history page.
The subprime mortgage crisis of 2007 to 2010 stemmed from an earlier expansion of mortgage credit, including to borrowers who previously would have difficulty getting mortgages, which both contributed to and was facilitated by rapidly rising home prices. Historically, potential homebuyers found it difficult to maintain and obtain mortgages if they had below average credit histories, provided small down payments, or sought high payment loans. Unless protected by government insurance, lenders often denied such mortgage requests. While some high-risk families could obtain small-sized mortgage backed by the Federal Housing Administration, others, facing limited credit options, rented. In that era, home ownership fluctuated around 65%. Mortgage foreclosure rates were low, and home construction and house prices mainly reflected swings in mortgage interest rates and income.
And Peter Schiff, he's president of Euro Pacific Capital. Gentlemen, thanks for being here. Peter, I want to start with you. Although there are more and more people saying that the U.S. economy will be in a recession next year, it is still a minority position. Why do you think that a recession is coming, and just how bad is it going to be?
I think it's going to be pretty bad, and whether it starts in 07 or 8, I think is immaterial, and I also think it's going to last not just for quarters, but for years. See, the basic problem with the U.S. economy is we have too much consumption and borrowing and not enough production and savings. And what's going to happen is the American consumer is basically going to stop consuming and start rebuilding his savings, especially when he sees his home equity evaporate. And when you have the economy 70% consumption, you can't address those imbalances without a recession. You know, rather than the recession being resisted, it should really be embraced, because the disease is all this debt-financed consumption. The cure is that we stop consuming and start saving and producing again, and that's a recession. And sometimes, you know, medicine tastes bad, but you got to swallow it.
Art Laffer, you hear him? He says the consumer's going to slow down in order to rebuild the savings. And you know that 2/3 of the American economy is driven by the consumer. Do you believe that?
No, I don't believe any of it whatsoever, Michelle. Excuse me. But, you know, what he's saying is that savings is way down in this country, but wealth has risen dramatically. The United States economy has never been in better shape. There is no tax increase coming in the next couple of years. Monetary policy is spectacular. We have freer trade than ever before. And not only that, but there are no incomes policies things here. I think Peter's just totally off base, and I don't think it's going to be, I mean, I just don't know where he's getting his stuff. The
well, one of us is
off
off base, but it's definitely not me. I mean, it's not wealth that's increased in the last few years. We haven't increased our productive capacity. All that's increased is the paper values of our stocks and real estate. But that's not real wealth, no more than the NASDAQ was wealth. When you see the stock market come down and the real estate bubble burst, all that phony wealth is going to evaporate. And all that's going to be left is all the debt that we accumulated to foreigners.
Peter, I'm going to take a bet with you on this one. I'll bet you a penny on this one that if you'll sign a letter saying that if you're wrong, you'll sign a letter that you were wrong to me in this, but you're just way off base. There is nothing out there that tells us we're going to have a nice slowdown, but it's not going to be a crash.
All right, let me ask you this.
I'll bet you a lot more than a penny.
Very few saw the recession coming, so when the mortgage bubble popped, the economy collapsed. This can be compared to the bank loan problem, which was greatly involved in the Great Depression. It is controversial whether the bank crisis caused the Great Depression or vice versa. However, the bank crisis of the Great Depression can be related to the Great Recession and the mortgage crisis because both overexpanded, leading to a steep downfall. In the Great Recession, the banks lent too much money to unqualified homeowners and left them with huge mortgages. The mortgage problem is highlighted here.
Because the bond funding of subprime mortgage collapsed, lenders stopped making subprime and other non-prime risky mortgages. This lowered the demand for housing, leading to sliding housing prices that fueled expectations of still more decline, further reducing the demands of homes. Prices fell so much that it became hard for troubled borrowers to sell their homes to fully pay off their mortgages, even if they had provided a sizable down payment.
This forced the market into a freefall along with lots of foreclosure on real estate. The bank problem in the Great Depression can be closely related to the overexpansion in the rate that banks were being built, which proved detrimental. It became relevant when there was a slight economic downturn and the farmers had less money to spend. This is shown on Living History Farms' essay.
As the economic depression deepened in the early 30s, and as farmers had less and less money to spend in town, banks began to fail at an alarming rate. During the 20s, there was an average of 70 banks failing each year nationally. After the crash, during the first 10 months of 1930, 744 banks failed, 10 times as many. In all, 9,000 banks failed during the first decade of the 30s. It is estimated that 4,000 banks failed during the 1 year of 1933 alone. By 1933, depositories saw 140 billion disappear through bank failure.
Because the banks were built at such a thriving time, nobody thought that there would be repercussions. This factored into the greatest economic downturn in United States history because banks were forced to close at such an alarming rate. Much like the banks in the bank crisis of 1930s, the mortgage crisis of 2008 was due to an overexpanding business, which hit the wall and then collapsed. It would be fair to compare the two and say that the banks in America made similar mistakes multiple times, which proved detrimental to an economy which thrives on security.